What is pre-shipment financing? Pre-shipment financing, also known as export packing credit, refers to the short-term funding provided to exporters to support the production, procurement, processing, and packaging of goods before shipment. This financing covers all costs incurred from the time an export order is received until the goods are shipped to the importer. It allows exporters to fulfill orders efficiently without facing working capital shortages. Pre-shipment finance can be provided in domestic or foreign currency. It is usually self-liquidating, meaning it is repaid once the export proceeds are realized through post-shipment financing or direct payment from the importer. Typical sources include commercial banks, export credit agencies, and government programs that promote international trade. Why is pre-shipment financing important? Pre-shipment finance is essential for exporters, especially in emerging markets, who often face delays in receiving payments from overseas buyers. Without sufficient liquidity, exporters may struggle to purchase raw materials, hire labor, or pay for logistics and quality inspections. Working capital support provides liquidity to cover manufacturing, packaging, and shipment costs before payment is received, enables timely production, ensures that exporters meet contractual obligations and delivery deadlines, encourages export growth, strengthens exporters' ability to accept larger and more frequent international orders, improves cash flow management, minimizes dependence on retained earnings or long-term borrowing, enhances competitiveness, allows exporters to offer favorable credit terms to buyers without facing liquidity pressure. Risks involved in pre-shipment financing. Credit risk. The exporter may fail to execute the export order, leading to default on the loan. Performance risk. Delays, quality issues, or supplier problems may prevent fulfillment of the order. Commercial risk. The buyer may cancel the order, reduce the quantity, or become insolvent before shipment. Political risk. Changes in trade policies, sanctions, or export bans may disrupt delivery or payment. Exchange rate risk. Fluctuations in foreign exchange rates between loan disbursement and repayment can reduce profitability. Collateral risk. The collateral pledged, such as inventory or receivables, may lose value before repayment. Fraud and documentation risk. Incorrect or falsified documentation can lead to non-payment or disputes. Types of pre-shipment financing. Packing credit. A short-term loan or cash credit facility granted to exporters to purchase raw materials, process, and pack goods for export. It is typically extended for 90 to 180 days and repaid once the shipment proceeds are realized. Advance against export order. Finance granted against a confirmed export order or irrevocable letter of credit, LC. The exporter provides evidence of the order, and the bank disburses funds to begin production. Advance against export incentives. Exporters eligible for government incentives, such as tax rebates or duty drawback, may receive advances from banks against the expected incentive receivables. Advance against hypothecation of goods. The bank finances goods that remain under the exporter's control. The exporter retains ownership but cannot sell goods without the bank's consent. Advance against pledge of goods. The bank takes physical possession of goods stored in a bonded warehouse and provides credit based on their value. Export credit agency-backed pre-shipment finance. Government or multilateral ECAs guarantee or directly fund pre-shipment loans to reduce the bank's exposure to default risk. For instance, the US EXIM Bank and India's Export Credit Guarantee Corporation, ECGC support pre-shipment credit through guarantees and insurance. Parties involved in pre-shipment financing: exporter, seller, the borrower who applies for financing to produce and ship goods under a confirmed order; importer, buyer, the foreign purchaser who issues a purchase order or letter of credit confirming intent to buy; exporting bank, financing bank, provides pre-shipment credit based on export documentation and assesses the exporter's creditworthiness. Export Credit Agency, ECA, offers guarantees, insurance, and credit enhancements that protect banks and exporters against commercial and political risks. Government authorities may provide subsidies, interest rate support, or tax incentives to promote export-oriented financing. Freight forwarders and inspection agencies support logistics, quality assurance, and documentation for export readiness. The role of the Export-Import, ECA Bank. The Export-Import Bank, EXIM Bank, plays a critical role in supporting pre-shipment and post-shipment financing for exporters. It is a government-backed institution designed to promote and facilitate international trade by mitigating credit and political risks. Key functions of the EXIM Bank. Pre-shipment finance guarantees provides guarantees to commercial banks that offer pre-shipment credit, reducing lending risk. Direct lending programs offers pre-shipment loans to exporters, particularly small and medium-sized enterprises, SMEs, for raw material procurement and production. Interest rate equalization subsidizes interest costs for exporters to maintain competitiveness in global markets. Insurance and risk coverage provides coverage against commercial and political risks, ensuring exporters are protected against buyer default or currency inconvertibility. Advisory and capacity building assist exporters in navigating foreign markets, regulatory compliance, and financing structures. How pre-shipment financing is used. Order confirmation. The exporter receives a confirmed purchase order or letter of credit from the importer. Application to bank. The exporter submits an application for pre-shipment finance, supported by export documentation and business financials. Credit assessment. The bank evaluates the exporter's creditworthiness, production capacity, and order authenticity. Sanctioning of credit. Upon approval, the bank issues a packing credit limit or specific pre-shipment loan. Disbursement of funds. Funds are released to the exporter to purchase raw materials, pay for labor, insurance, and logistics. Monitoring and compliance. Banks may monitor production progress and inventory to ensure that funds are used for export-related purposes. Shipment and documentation. Once goods are shipped, the exporter submits shipping documents to the bank. The loan is then adjusted or repaid through post-shipment finance or export proceeds. Reporting and settlement. Export realization is reported to regulatory authorities, and foreign exchange compliance is ensured under national and international trade finance regulations. This concludes our discussion about the pre-shipment financing. See you at the next lecture.